Hi guys, welcome back to the case study. So we have completed till equity schedule and I really hope you are absolutely clear with how do we actually make the equity schedules. Fair enough. Now let's try and do one thing here. Whatever items that are there that we can fill in from ourselves at this point, let's just fill in our financial statements and subsequently we'll go and prepare the debt schedule. All right, so let's just come to the income statement. Interest we are yet to compute, so I'll still leave it as it is. Then I had certain percentages, certain analysis that I was making. Revenue growth rate, COGS, SG&A, right? So the formulas have been already applied. You just need to drag it further to check, okay, what is the revenue growth rate going forward? Okay, fair enough. Then COGS as a percentage of revenue and SG&A as a percentage of revenue. Okay, fair enough. So this is the analysis that comes from the income statement, right? So now our income statement up to this point is absolutely filled in. So we're done with income statement. Yes, I know interest is there, but then again, interest will come from the debt schedule, and let's just hold on to this for some time. Okay, cash flow statement. Now let's look at the cash flow statement. Net income. All right. Now, where do I connect this net income from? Now, net income will be the net income from the income statement. All right. So, net income, link it to the net income. Depreciation, please link it to the depreciation. Now, I need to add the depreciation back. Why do I add back depreciation in my cash flow statement? I hope you are absolutely clear with this concept. Yes, it is a non-cash expense. So while arriving at this net income, I have already subtracted depreciation here. Now, since it is a non-cash, I need to exclude this effect from my cash flow statement. And since while arriving at this net income, if the depreciation has already been subtracted, so how will I nullify this? How will I nullify this? So I will be adding it back by the same amount. So this is the reason why I add back depreciation in my cash flow statement. So equals minus sign and then link your depreciation. Why minus sign? Because I need a positive figure here. If I don't put this minus sign, it will take the negative figure, as in our income statement it was shown as a negative number. Alright, so copy this ahead. Deferred income taxes. We have already computed deferred taxes. So let's just link our deferred tax. Fair enough, this much is our deferred taxes. Okay. Then we have other. Other, we don't have any information regarding other, what this is for the operating activities. So I will take it as 0 going forward. Okay, and then let's just put in the totals. Fair enough. Capital expenditure. Do I have the figures? Absolutely. So let's just link the capital expenditures. Do we have any information for asset dispositions and again other investing activities, something other? No, right? So again I will take it as 0. Coming to the financing activities, let's leave this revolver because this will come when I will complete the debt schedule. Leave the variable long-term debt, leave the fixed long-term debt. We'll come to this once we are done with the debt schedule. Again, we have something known as other here. So 0. So do fill in the totals. Do fill in the totals. So total financing activities as of now. Okay. Cash movement during the year. This is the sum of my operating, investing, and financing activities. And I have some opening cash balance here. So, what will be the opening cash balance in 2018? The closing cash balance of 2017. All right. So, is it the same as balance sheet? Yes. Perfect. So, don't forget to put in the totals. Okay, fair enough. Cash and cash equivalents. Let's come to the balance sheet now. We have linked everything that we can in income statement and cash flow statement. Now coming to the balance sheet. Balance sheet. Cash and cash equivalents. I have to link this from the ending balance of cash flow statement. Fair enough. Goodwill and other intangibles. We were given in the case study that I need to take it as a constant number throughout. So let's take it as a constant number. Okay, one Excel hack here. Now I need the same number in all the years, and that number should be linked to this 2017 number, right? So I need the same number going forward. So how do you do this? So one option is you first link this, then copy, and then press enter. This is one way of doing this. Another way of doing it is simply select the cells where you want this number to be copied. Press equals and link what number do you need. And instead of pressing enter, press control and enter. So you will observe everything, the number gets copied to all the selected cells. Alright, let's try this here in intangibles. I'll select all the cells which needs the copying of. Then select this number, control enter. Right? Okay. Total non-current assets. I'll just put in the formula. Okay. Coming on to the liability side, revolver. Let's leave revolver as of now. We'll fill in. Put in the totals. Variable debt, leave this. Fixed debt, leave this. Deferred income taxes. Now, since we are talking about the balance sheet, and the balance sheet is going to have the balances, right? So what should I link in the deferred income taxes? So the deferred income taxes would be whatever was the opening balance, whatever was the balance in the end of the previous year, plus whatever is my new deferred taxes. Alright, and just copy this across. Do this. Then other non-current liabilities, again let's take it as a constant value and just fill in the formulas. Okay, preferred shares we've already filled in, common shares filled in, retained earnings already computed. Now again other, right? So let's take it as constant. Fair enough. Totals and checks. Now you will observe your balance sheet is not matching. Can you tell me why? Well, that's a very silly question to ask. Yes, because we haven't yet added the debt numbers, right? So all we need to do now is add the debt numbers and interest numbers, and my balance sheet should match. So let's take it as a challenge to match the balance sheet in one go. and let's start. Okay, I hope we are together till this point. Now, once you're done with this, again, guys, if you are lagging behind, just pause the video, right? That's the benefit of having it as a recorded session. Just pause the video and reach till this point. If you're done, then only resume. Okay, let's come to the case study and look at the last thing that we need to do, the debt assumptions. Okay, now we are given that the interest rate on fixed rate term debt, that means the interest rate on fixed term debt. Now, what is the difference between fixed rate and variable rate? Right? Fixed rate, as the name suggests, the interest remains fixed. Right? So let's say if you take a loan from the bank at 12% per annum, that is your fixed rate term debt. The interest rate remains fixed. However, if the bank keeps on fluctuating your interest rate, that becomes your variable rate term debt. Okay, so it is being given to us that the interest rate on the fixed rate term debt and the revolving credit facility, also known as revolver, is 3.1%. Now you will ask me, okay, fixed variable, I know this, I get this, that okay, the rate remains fixed, the rate fluctuates, so that is the difference between fixed and fluctuating debt. Okay, but then what on earth is revolver? So we will talk about this revolver concept while we are doing the debt computations. Okay, just stay with me, just hold on to this revolver concept, and we'll do this once we are done with some of the computations. Okay, fair enough. The variable rate term debt pays interest at a variable rate equal to LIBOR plus 55 basis points. So LIBOR is your London interbank exchange rate, right? So LIBOR plus 55 basis points. So LIBOR keeps on fluctuating. So whatever is the rate of LIBOR, I will add 55 basis points to it. So 55 basis points means 0.55 percentage, right? So whatever is the rate of LIBOR, I will add 0.55% to it. The case study further says that assume that the LIBOR is 1.1% and will remain constant. So if the LIBOR is 1.1%, what is my total variable rate, total variable interest rate? Is it 1.1% only? No, it is 1.1% plus 0.55%. All right, so we'll see that computation. Then we are given that any excess cash. What is excess cash? Whatever is my cash after meeting all the commitments that is lying with me, that is excess. That excess cash will earn the interest income at a rate of 1%. So it's not only the interest expenses that a company incurs, the company also gets the benefit of having a surplus cash, right? So in a sense of interest income from the bank. Okay. Amortization on the fixed rate term debt. What is amortization of fixed rate term debt? This is nothing but a repayment of debt, right? So repayment of debt is also known as amortization of the debt. So the case study says amortization on the fixed rate term debt will be $200 million per year until the debt is repaid. So every year it will be $200 million until the debt has been repaid. Okay. Amortization on the variable rate term debt will be 300 million per year until the debt is repaid. So fixed debt will be repaid in the amounts of $200 million, while the variable debt will be repaid in the amounts of $30 million. Okay. The company will draw on its revolver if it ever has a cash shortfall. Okay, so since this line has come here, let me just give you a brief about revolver. Now, revolver is a uh, a threshold, a limit given by bank, saying that okay, as and when you require the money, you can just take it from that, take it till that threshold, right? Suppose I have an agreement with my bank saying that okay, I have a threshold of, let's say, 10 lakh rupees, right? So up to 10 lakh rupees I can withdraw it whenever I need it. Okay, now this is revolver. So it says the company will draw on its revolver. That means the company will take it from that limit if it ever has a cash shortfall. So whenever there is a cash shortfall, the company can take the money from the revolver facility. Okay, this is revolver. Now you have another question, I know, that okay, then what is the difference between a normal debt and a revolver? So the difference between a normal debt and a revolver is that in your normal debt, your repayment schedule is fixed. Be very careful. I am not talking about the interest rate. I am talking about the repayments. That is fixed, right? So when you take a normal debt from the bank gives you a repayment schedule, right? So that repayments are fixed in case of normal debt. But in case of revolver, the repayment is not mandatory. When you have the money, you pay it to the bank. If you don't have money, it's fine. But then again, you will ask a very silly question, that will the interest be charged in the outstanding amount? Absolutely. Absolutely. Then you have another question, I know. Then what is the benefit of the revolver facility? Well, the biggest benefit of the revolver facility is that you are not required to make the mandatory payments. And as and when you require the money, you can get it. Right? So this is your revolver. Okay. Last point, the revolver has a cash sweep such that whenever there is a revolver balance outstanding, all excess cash available after mandatory debt repayments, share issuance repurchases, and dividends goes towards paying off the revolver. That means whenever the revolver has an outstanding balance, that means you are yet to pay on your revolver facility. Then if you have excess cash, if the first thing that you will pay off is the revolver facility. Okay, fair enough. So that's my debt assumptions. Before we dive into the computations, let's bring these debt assumptions to our input sheet. So go to the input sheet, have a next segment of debt assumptions. So let's start. Interest rate on fixed rate term loan or term debt. Interest rate on fixed rate term debt. Now what is the interest rate? It was 3.1%. Right? Interest rate on fixed term debt was 3.1%. Interest rate on revolver, again 3.1%. Then interest rate on variable rate debt. Interest rate on variable rate debt, that I need to compute. So we will be computing this. Let's see. LIBOR is given to us 1.1%, and since it has to remain constant throughout, we are taking it in the constant column only. Then additional basis points, or you can write basis points to be added, 55, or you can make it as 0.55%. So what is your interest rate on variable term debt? This is the sum of LIBOR and the additional basis points that you add. That becomes your 1.7%. Okay. Now, next it was given that interest rate on excess cash, I will generate some income also, that is 1%. And it was further given amortization of fixed rate term debt, it was what, 200 million, 200 million until repaid, and amortization of variable rate debt 30 million until repaid. All right, so these are my debt assumptions. Now you know the drill, we need a separate debt schedule for this. So let's just copy our template sheet and rename it as debt. Don't forget to change the name, debt schedule. Reach till this point, guys? So we'll do the very first computation, fixed rate term debt. So the very first computation under fixed rate term debt will be ending balance of fixed rate term debt, and we know now how do we actually compute the ending balance. We have beginning balance for fixed rate term debt. We're going to add debt raised during the year. We're going to subtract amortization, and what we'll get is our closing balance, ending balance, fixed rate term debt. Don't forget the units. Reach till this point. Now, do I have the ending balance as on December 2017? Yes, we do. Go to your financial statements and link the ending balance for 2017. Fixed rate term debt, this is 1053.9. So we have ending balance as on December 2017. Can we find out the opening balance as on January 18? What will be my opening balance as on January 18? Again, this is equal to the closing balance of previous year. So the closing balance of previous year becomes my opening balance this year, right? Do I have anything for debt raised during the year? No. Do I have anything for amortizations? Yes. 200 million every year. Closing is your beginning plus raised minus amortization, and that's it. This will give you your ending balance of fixed rate term debt. I'll give you some seconds, do this computation. Now, I hope you are with me till this point. What else can we find out for the fixed rate term debt? Interest, right? Interest expense for fixed rate term debt. How will I find out? I will have to compute my average debt, right? We all know this. I have to compute my average debt. So I have a next subheading, computation of average debt, right? Computation of average debt. This is very simple. Your beginning balance and your ending balance. Just copy it across. Why average? Because we've been discussing this earlier as well, that your debt is applied, or sorry, your interest is always charged on an average debt balance. Why average? Because I have to factor in these movements also. If I bring in something during the year, if I repay something during the year, so I don't want to go to the nitty-gritties of this, as in what dates I am taking the debt, what date I am repaying. I don't have to match my computation to the very date. For yes, obviously for accounting I have to do, because that is affecting my books of accounts. But for financial modeling, I don't go into so much of details. So I do it on an average basis only. All right. So how do you compute the average debt? Simple, average of these two. So of course, why do you get errors? Because it is, there are no values here, right? And hence you get the error. Okay. So if error, so if this computation results in an error, then give me 0, right? We have practiced if error. Now I can compute my interest expense. I have average debt, just computed above. And interest rate I can bring in from my input sheet. And compute the interest rate on fixed rate term debt. Simple computation, your average debt multiplied by 3.1% and do a column free share. Why? Because I don't want this to move. Okay. Giving you some seconds, guys. Reach till this point. Okay, fair enough. Now, that's it for the fixed rate term debt. I need to do exact same thing for the variable rate term debt, right? So, simply change the word fixed to variable. One more thing, since I have everything same, I can copy these entire rows from above, place it down, and just change the numbers that I need. So I will save my time with writing this down, writing these things down, because I have already written this. Okay, now I just have to change the word fixed to the variable. So copy these and find and replace the word fixed with variable. Right? So find fixed and replace with variable. Okay, so you will notice that wherever it was fixed written, it changes to variable, right? It will change on the things where you have a manual input. If you have linked something from the input sheet, that you have to change manually, like the interest rate, right? So we'll come back to it. So the beginning balance, okay, the ending balance of variable rate term debt as on 2017, do we have this figure? Yes, we do. We do have this figure in the balance sheet. So let's go to the balance sheet and link variable rate long term debt 274.8. Do we have any information for the debt raised? No. Do we have any information for amortization? Yes. $30 million per year. 30 million per year. So now that's it. You just need to change the interest rate. Totals are there. Average debt has been computed now, right? So you've computed the average. Just change the interest rate. Interest rate on fixed rate it was given, and we'll change it to interest rate on variable rate debt. It was 1.7. Right, and you'll see the numbers getting calculated automatically, because above this you have already done this computation, you have just copied the row, so the formulas also get copied. All right, reach till this point. Okay, now fixed done, variable done, revolver. Guys, I hope you're saving your files to as you go along, right? Make it a habit. Keep saving your workbooks. Okay, keep saving. Now, revolver. Now revolver computation, guys, be very very careful with this. Do it along with me. Okay, do it along with me. Your cash movement before having any debt. What is my cash movement before debt? Now to get to revolver point, I have to see what is my position of cash, whether I have excess cash or whether I need to take something from the bank, right? So the first thing that I do is I link cash movement before debt. So how will I find that cash movement before debt? It is very simple. Go to your cash flow statement. Okay, go to the cash flow statement and add everything apart from debt. So how do we do it? So I will add operating activities, cash from operating activities plus cash from investing activities. Then now do not link it to cash flow from financing activities total. Never do this mistake. Always link it to the individual components except debt. Always link it to the individual components except debt. Okay, so how have I arrived at this number? Sum of cash flow from operating activities plus cash flow from investing activities plus individually preference shares, common shares, preferred dividends, common dividends and other. I am not linking this to the total, and do not make this mistake. We'll talk about why in just a while, okay? But always remember to link to the individual components except debt. Just leave the debt components and link all the individual components. Okay? So what you have is your cash balance before debt, cash movement before debt. Now, is it my ending balance? No. I have some opening balance of cash as well. Again, I will source it from the cash flow statement. Opening balance. Okay, so opening balance. Now, as of now, I haven't paid anything, right? As of now, I haven't paid anything. So whatever cash that I generate during the year plus whatever cash balance that I have, isn't that my cash available for debt repayments? Right? So I have to repay the debts, remember? I haven't yet factored in debts. So where do I factor in debt? So for that, first I will have to compute what is my cash available for debt repayments. Right? How much cash I have to repay the debt? Simple sum of these two. So this is my cash available for debt repayments. Out of this, I will subtract amortization of fixed rate term debt, and amortization of variable rate term debt. 200, link from the source workings. Then 30. You can also link it from above, that's fine here. Now this is my net cash position. Now this is my net cash position. So cash available for debt repayments minus payment for fixed debt minus payment for variable debt. Okay. Now, tell me, can I have a negative cash balance? Can I have a negative cash? Can you have a negative 100 in your wallet? No, right? So this negative cash means this is my cash shortfall. That means I will have to take from bank this much amount of money, right? So let's compute the ending balance of revolver. Again, beginning. So let me just bring everything here from here. Let me just bring everything again. Now I have to do the same computations. Now instead of variable rate term debt, it will be revolver. It will be revolver. So do the same thing. Replace the word variable rate term debt with revolver, please. Variable rate term debt and replace with revolver. Okay, so ending balance of revolver, that's fine. So now you'll see my average rate term debt, variable rate term debt will be replaced by revolver. So press Ctrl H, find and replace. Do this. Okay, now do we have an ending balance for 2017? Let's check the financial statements. Balance sheet, where is revolver? It's zero. It's zero, but still we will have to link it. Now, for the debt raised during the year, that means draw on a revolver. That means you're drawing on your revolver. How much will you draw on this revolver? The amount of shortfall? How much will you take from the revolver? Whatever is your negative balance here, right? Because that is my cash shortfall. This negative balance is my cash shortfall, right? So this much amount I need from the bank. So this much amount I will draw from the revolver, right? So what will I say? If this number, if the net cash position is less than 0, if the net cash position is less than 0, then minus of this number only, I will draw this much amount, otherwise give me 0. If it's positive, I am not going to draw anything, right? If it's positive, I am not going to draw anything out of this. do this. Okay, so now you have taken this amount from the bank. Will you not repay this? Of course you will. When will you repay? When you have positive net cash position, that means you have this much amount even after paying your fixed and variable debt. You have this much amount. So you can pay this, you can pay the revolver also from this amount. So how will I repay the revolver? I will say, if this amount, the net cash position, is greater than 0. If it is less than 0, I draw on the revolver. If it is greater than 0, then how much will you pay? How much will you pay? Okay, let me just explain this and then we'll build the formula. Okay, now look at this very, very carefully. Let's hypothetically let's take an example. Your cash position, okay, net cash position is, let's say, 50, 60, 70. Okay, and your outstanding balance on revolver, that means the opening balance during the year of revolver, is, let's say, 60, 30 and 50. Now tell me, in 2018, how much should I repay? Now you might want to say 60, but my dear friends, do I have 60 available? No, I have only 50 available. So I will repay only 50 here. So I will repay only 50 here because I have 50 only with me. Then in the next case, let's look at 2019. The cash position is 60 and the outstanding balance is 30. How much will I repay? Now you will say 60. But why? My outstanding balance is only 30. Why will I give 30 extra to the bank when it's not needed? Right? So I will repay 30 here. In 2020, my cash position is 70. My outstanding balance is 15. How much will I repay? Of course, 15. Right? So what can you infer from this? What is your interpretation now? Your interpretation should be, okay, out of these two, whatever is the minimum, that I will repay. Right? Whatever is the minimum, that I will repay. That's it. That's what you need to put in the formula. So if the net cash position is greater than 0, then minimum of your net cash position or whatever is the opening balance of revolver, because that is what my outstanding balance is, right? Otherwise give me a 0. Otherwise give me a 0. Then interest expense, okay, average is already computed. Interest expense, let's bring the interest rate on revolver from the input sheet. And you'll see your numbers popping up automatically. Okay. Now, revolver done. Now I have excess cash as well. In case I have excess cash with me, In case I have excess cash with me, then what will I do? I will get an interest income, right? So this is my cash and cash equivalent from the balance sheet, because that is what my excess cash is after meeting all the commitments. So cash and cash equivalents linked from the balance sheet. Don't worry guys, I know your doubt here that Ayush, I still haven't put in the debt numbers yet. How can I get the excess cash? Don't worry. We'll be linking now everything after. So we are just computing everything, and now as and when we start linking, our numbers will get changed accordingly, right? So we'll see to it. Cash and cash equivalent, this much. Then I have an interest income on excess cash, which is nothing but 1%. So what is your interest income on excess cash? Simple. Your cash multiplied by 1%. Now this is your excess cash reached till this point. This is your excess cash. Okay. Now everything is computed now. Now I need to link interest expense in my income statement. So let me compute the total interest expense. I have it at different places, but let me just bring it together. So interest expense on fixed rate term debt, interest expense on variable rate term debt, interest expense on revolver, interest expense, interest income on excess cash. So let me just copy everything. Now what will you do of this interest income? I will take it as a negative number. Why? Because what am I computing? I am computing total interest expense. So whatever is the interest income, I will just net it off. Total interest expense in million, sum of everything, and there's your end of sheet. Finally you can take a sigh of relief. So we are done with the debt computations, and we've come a long way. Alright, that completes my debt computations. Now please, I am repeating this one more time, please save your workbooks here. Alright, please save it here. And let's start linking the numbers. Ending balance of fixed rate term debt, I can link it to the financial statements. So first thing, your fixed rate term debt, let me link it to the ending balances. Okay, so that removes your first highlighted cell, highlighted row. Okay, let's come back to the debt. Now, okay, variable rate, ending balance of variable rate term debt. Let's link the ending balance of variable rate term debt now. Again, removing my next highlighted row. Revolver, I have ending balances of revolver also. So let me link it to the ending balance of Revolver. Fair enough. So that completes my balance sheet. Okay. But you will observe that, hey, wait, Ayush, it's still not matching. Well, wait a minute, because I am still to put in other figures in my cash flows and income statement. So let's start with cash flow. Revolver issuance or repayment. So sum of whatever is my draw or amortization, right? Or what you can do is you can say, okay, let's net it off. Whatever I raise minus whatever I repay, right? So let me just net it off in the cash flow statement. Fair enough. Then variable rate long-term debt. Variable rate long-term debt. Again, same thing. Again, the same thing. You have debt raised minus amortization. Now, for fixed rate long-term debt, for the fixed rate term debt, again, same thing. Raised minus repaid. Okay. Now, I am done with my cash flow statement as well. Now, one thing is left, and that is in income statement, which is my interest expense. So equals minus, and I link this to my interest expense. And I'm done. So that's it. So let me check if my balance sheet is matching or not. And as you can see, my balance sheet has matched. That's amazing, isn't it? So it never matches in my exam, right? But here we have perfectly matched the balance sheet. Okay? Congratulations. So you have finally completed this case study, my dear friends. I hope you have understood now the art of building financial models. Yes, of course, this doesn't factor so much of the international standards on modeling, but yes, all the important guidelines, all the important things, not all, but some of the important things I have already factored in here for you. Okay, fair enough. So one last thing we are now left with is preparing a dashboard for it. So let's prepare a dashboard in the next video, guys. That's it for this video. I hope you are able to grasp the concepts. I hope you are able to complete this case study. I'll see you around in the next video, guys. All the very best.